because the game might be pretty long. Like Amazon was not profitable for I think more than 10 years, right? Before the price just skyrocketed. And who would have believed you if you told them on year 2 that this is the 10x stock of the internet age? So time will tell.
Right.
Moving on from Alibaba, I want to talk about like the international markets in general. So I made one episode about like Macrotrends. So I talked a bit about fintech, like green tech, and the metaverse. So what do you see as big trends coming up for the next decade that you use to sort of source your ideas for investing around? Yeah.
I think that's really a very interesting question, and especially for young people like us. Of course, I would qualify us as young. I think we are the future of this entire globe, and whatever we are thinking on our minds, that's where we will put in our time, our effort, and how we will try to help break that frontier in our own capacity, be it in work or even in our own free time. So personally, I do understand that there are quite a few very hot topics. So you have people like blockchain, green tech, all these metaverse. So all these huge topics, or a lot of the discussions online, or at least in the online realm, revolves around all these different discussions. Personally though, I'm actually quite excited in terms of AI and automation. Not trying to be a skeptic of replacing low-end jobs and a lot of all these mundane jobs, right? But if you were to look at it, the trajectory seems, at least in these two fields, right? AI and automation, there are practical uses. I'm not saying that, of course, I'm not saying metaverse has no practical use, but it seems like a lot more funds, a lot more concentration in all these different, trying to make all this come into fruition, like make all this really turn into reality, because there is a business need to it. If you can drive costs down, you can increase margins. All these are real value addedness to all the different businesses and enterprises. So that's one. That's one trend. The second trend I do agree is, actually personally I have been researching, or at least attempting to research into the green tech space, and especially all these solar talks, a lot of all this sustainability and a lot of ESG kind of thing, right? But I feel like there will definitely be a time for it to shine, but I will have to be prepared to be able to take advantage of that curve. So I have to do my own homework. I have to understand what it means, what are the companies pushing for, and all the different panels and what are the cost economics, etc. But that said, because I know that I am not that geeky about it, in comparison to like technology, for example, I might be more interested in Facebook or Amazon's business model rather than people selling solar panels. So in that case, I'm actually looking into trying to increase my exposure in terms of at least an ETF. And whether is it a broad-based ETF that comprises of the whole world's solar or green tech related companies, or China-related one, I think maybe I'll do a video to cover that. But I personally now, I look towards, or at least I'm tending towards more Chinese-related, because I seem to have more affinity with a lot of all these Chinese companies. And I think if you were to look at the trends and what are the commitments of the highest level of governance and how all the different countries are pressuring each other, I think you probably cannot really go wrong if you're betting on this sector, and specifically if you're betting on China. But then, of course, again, a lot of political risk, execution risk, and all this. So you will have to do your own due diligence and to look into how you are able to stomach those on your own. Yeah. So these are the two trends that I personally am more interested in.
AI computing and second one, how
green tech.
Green tech as a general.
Yeah.
Okay. Cool.
Yeah.
Cool. So I have to remind myself that like there's a commitment required to get into a new industry. You know, like the amount of time you need to do.
Yes.
So it's like I'm not rushing into it myself, although I'm interested in all of those macro trends. Okay, next question would be for a young investor like yourself, and to a lesser extent myself, what characteristics of a business do you think attracts and is worthy of that attraction, like something that you can hold for until your retirement age? What do you think young investors should look out for in a company, that X factor, if you will?
Right. I think it's a very tricky question, because I believe that in your entire investment journey thus far, you will definitely pivot. You will definitely look into your entire investment approach. In different stages of life, at a different life cycle, there will definitely be different opportunities. That's one. There'll be different objectives as well. So in this case, I can't really prescribe because it's on a very individualized basis, and because we're not financial advisors, it's always best to try to find someone a lot more professional, and it's their day-to-day job to advise you on what to do. But personally, if you were to ask me as a blanket question, if just specifically for young people, what investment instruments or what industries should you be looking at, I would venture you guys to look into higher risk assets, like equities, not so much into bonds, maybe sometimes even into cryptocurrencies. Of course, barring the fact that, or with the caveat that, hey, you know what you're doing, you know what you're investing in, and you really believe in what you invest. Because the emotional turmoil when you lose money, I think that's horrendous. And I do not wish anyone to experience that. But if you are invested in the market, that's something that you cannot run away from. So that's the thing, right? As the younger you are, unless you are like a Saudi prince or your parents are billionaires, you don't start out with an extremely huge capital. So by huge capital, I mean at least in the 6-7 digits. So if you're starting out with 5 digits, you have 10K, 20K, 50K to burn. Of course, I wouldn't say burn. It's a lesson to be learned. You are essentially paying school fees to the market. You learn yourself. Investing is a very expensive game to know yourself more. Screw all the personality tests, all the different psychiatric assessment, or even talking to a psychiatrist, for example. The stock market is the easiest and the fastest way to learn how you react as a person and to understand yourself on a much deeper level. So in that, if you look at it from that stance, I think for young people, at least in maybe their early 20s, late 20s, early 30s, it's good to always the lessons you learn can benefit you in the subsequent 30, 40 years when it's achieving that compounding effect. Of course, if you're like a genius, you're like Buffett, since young he starts compounding at an astronomical rate, then kudos to you. Of course, I hope that you will do even better. But I think at least for people like myself, right now I'm also still learning, still investing, and still I'm trying to learn the ropes, get a lot of different advice and opinions from many different people. And which is also why I thought that YouTube as a platform is a very interesting platform. You get to hear all sorts of opinions. People that are pro-China, anti-China, people that are pro-equities, anti-equities, pro-cryptocurrency and anti-cryptocurrency. So these are the diverse amount of opinions that you have to take in. Some like to look into macroeconomic factors. Some like to talk about all the different industry-specific factors. All these are good information and good reference materials. But that said, if you're too busy, if let's say you're an engineer, you're a lawyer, you're a doctor, and you don't wish and you have no interest in this, stay invested, buy an S&P 500 dollar cost average. That's the easiest way and the I wouldn't say the surefire way,
but tested, well tested.
Right, it's time tested. But maybe this is just my own opinion. I would like to put it out there because I think that it's not this entire thing that I'm going to say later on or in the subsequent sentences. I think not enough people are promoting it, or not enough people are raising awareness for it. It's true that the S&P 500 has went through the test of fire, went through World War I, World War II, all the Great Depression, all your different financial crises. That's it. That's a back-tested formula. They survived for 100 years. They return you a compounded average of 8 to 10%. Does not mean that they will continue returning the 8 to 10% for the next 50 years or for the next 100 years. Nobody here is to guarantee you that even the US dollar it doesn't guarantee you anything. It has the backing of the US government. Who is to say that there might be a change in world order, there might be a change in how things are being perceived, and how you know that all the greatest companies of the world will stay in the S&P 500. I think all these are unknowns that we have to start getting comfortable with. And maybe for people that are in the older age band, in their 40s, maybe in their 50s, I think for people that have the tried and tested way, sure, carry on with your dollar cost averaging into a broad-based index. But I'm just trying to remind people that if you really want like a surefire way, maybe you might want to look into a international exposure broad-based ETF. I think there are a few that actually buys into the entire world economy. It diversifies across like 9,000 companies or something.
Right.
So maybe that might be a more hedging way, but of course your returns will be kept because you're diversified across so many things.
Yeah, and,
so that's just,
and if your investment goes down, the whole world goes down to more or less
Right.
together with it. So yeah,
Right.
you hedge your bet
Right.
on the world.
Right.
That's a pretty interesting idea. Yeah.
Yeah. So that's my own take on S&P 500. Of course, personally, of course, I don't have exposure in the S&P 500. I would want to start it soon, maybe when I start working or when I have a full-time income coming in. But personally now, I'm taking quite a quote-unquote risky bet to a lot of people's eyes, because you start betting on companies means that you're increasing your risk exposure by tens of thousands of folds compared to a broad-based ETF, because there are company-specific risks and idiosyncratic risks that cannot be diversified away. So in that sense, you have to weigh the pros and cons in your own financial journey as well. Yeah.
Right. Yeah. I think like Peter Lynch said, right? Like investing is not even like not in the brain, it's the gut. Basically, it's like how much conviction can you have, and when you're young, if you're young and have the time to like spend a lot of time understanding a company really well, then you are risk adjusted. You are more likely to be risk adjusted, going long in that stock. So it really depends on your situation. But generally, I would say young people tend to have more time. So it'll be weird to see a young person like, almost all in completely bonds, bonds, and like maybe old blue chip dividend paying stocks. So it's like kind of weird, I would say. Yeah.
Yeah. Actually, I do understand why some people just hate the idea of losing money. So they would rather have something that is capital guaranteed in nature, which is like bonds, for example, or some structured notes that give you capital guaranteed returns. But the issue then is you really have to understand yourself. And like I said, the market is the best way to understand yourself in the shortest period of time. So in that sense, I don't think that even though I do highly encourage people in their early 20s to go into 100% equity, might not be stock picking. You can go S&P 500 or buy KWEB, which is the Chinese internet tech sector. Up to you to decide. But that said, of course, we do have to take into account the ability to stomach. You being able to stomach 30%, 40% loss doesn't mean that somebody has that ability. Maybe once they hit 10%, they might want to cut loss because I can't sleep at night. And that's a very important barometer to know that whether you have that good night's rest, whether that you don't have to be constantly checking your portfolio, checking your brokerage account. That's a very toxic behavior to begin with. And if you go down to the core of investing, people invest for financial freedom. People invest because they want to make money. But if at the expense of your mental health, your mental well-being, your sleep, it loses its purpose. And I see no point if you're doing it that way. I'd rather you keep it in the bank and earn that 0.05% interest rate.
Good point. Yeah, that's a good point. All right, moving on. Let's talk about like starting investing, starting out in investing. What do you think is interesting about investing other than, the ability to reach financial freedom at an accelerated rate? Yeah, what do you find particularly interesting? Is it the history, like the amount of the way you can test your ideas with a huge community? Yeah, what's attractive to investing to you?
I think personally, when I first started out, the interesting thing was because I was exposed to equities market from a very young age. So from a very young age, everybody's, how would I put it? Their childhood dream was to be an astronaut or to be a policeman or whatever, right? I still remember vividly, I think it was in primary 3 or primary 2, when my teacher told me, what do you want to be when you grow up? If I'm not wrong, I wrote stockbroker or I wrote a banker, if I'm not wrong. I think my entire life was heavily influenced by my dad, because my dad is also an avid investor. He invests a lot. He had his fair share of being burnt in the 2008 crisis, even in the dot-com bubble as well. That said, I think it's for me personally, at first, of course, it's always to earn money, right? Everybody wants to earn money. Who doesn't want to? But people always don't talk about the downside risk. People don't talk about the ability for you to lose capital. When you have 50,000 and then it goes down 50%, you lost 25K. That's maybe one person's annual salary. And nobody talks about it. It's not glamorous to talk about losing money. And which is why everybody's risk profile is different. Your objectives are different as well. One person can say that Tesla is the best to the moon. Alibaba to the best to the moon. But you have to make that personal judgment yourself, especially if you are into stock picking. So which is why I definitely do encourage the general public to just stay invested by a broad-based ETF. But if you want to start picking stocks, Actually, from when I started understanding a lot more. Okay, so initially for my journey, right, I was buying blue chip stocks. I think I was under that category because why? I look around Singapore. You have Keppel Corp, you have your Sembcorp Industry, you have your DBS Bank. Those are the brands that I know. So of course I'll buy into those companies. But then you realize, and you come to realize about risk-reward ratio. You start realizing that, hey, you don't really understand the business model. You bought just because it's a Singapore household brand. Then I extracted my money out from all these blue chip stocks, and then I start venturing out into US equities, China equities, Hong Kong equities. And then currently, at least for now, the most alluring thing about investing is for me to really think of it from a business perspective. At least, or some of it might call it maybe I'm more of like the strategy department of the company. So what is the strategic advantage? What's the competitive advantage? How do I look at it from the point of view of the owners, or especially the chief executive? How is he trying to position himself? So when I think about GrabFood today, GrabFood deliveries, for foreign viewers, it's the equivalent of DoorDash, Uber, all those. It's a food delivering platform. If you think of it, if you go through the earnings call, you listen to how the management team pitch the company's end goal. The end goal is to be a super app. But if you were to really think about it, to me, why am I personally not invested into Grab? The business model is a profit-losing one. And out of every single company that are in the same industry, every single one of them are profit-losing. You can fact-check me on that. Meituan in China is losing money. They're not profitable. Uber is also not profitable. Even if you look at all the different out in Turkey, in Africa, you have all these food delivery providers as well. None of them are profitable. So what are they trying to achieve from this business model itself?
Winner takes most, right? Basically, winner takes most. Winner takes all, right. Winner takes most.
Right. So the logic is they want to have the biggest market share, and then subsequently they can increase their prices. But then you realize that in the Singapore's case study, we started off with Uber, and then came in Grab. Then Uber got chased away. Then now we have Gojek, and then we have Food Panda, we have Deliveroo. And you realize that, hey, consumers are extremely price sensitive. You can say that, oh, today you have 80%, 90% of the market share. But tomorrow if Food Panda comes in, hey, I offer cheaper than Grab, you're going to switch over to Food Panda. You ask yourself as a consumer, when you make the purchase beforehand, you'll start switching into apps and see which is cheaper. Because the service that is provided is not differentiated. It's the same. You want to get from point A to point B, or you want KFC today. So the real differentiating factor here is time and probably the cost. So in this case, there really isn't an economic moat surrounding the company. And if you have to think about it from a strategy front, what are you supposed to do now? Yes, I pivot. I want to be a super app. I want to earn money from my finance arm as well. I don't want to just be a food delivery platform. I want to start charging loans. I want to be able to give you credit. I want to earn the interest rate, and I want to start going to fintech and disrupt banks. So that's a good strategy. That's something that we can work with. But that's it. There are a lot of execution risks. So for example, if you look at case studies like Ant Group, for example, maybe China comes on very hard down on China. But that's it. Singapore is also a highly regulated environment. Yeah. So what makes you think that we are highly different? So which is why it triggers you to think a lot deeper into all the different business models. And this is something that when I have that conversation with another fellow investor who's also an avid followers of business model, you're able to exchange thoughts and maybe look at things from a different perspective. And from this case, to me, Grab is no longer just a food delivery platform or a ride-hailing platform. To me, it's so much more. Right. And you can start discovering a lot of how they start earning profits, whether are they sustainable or not, whether they are shilling investors. Of course, I'm not saying that they're fraud or whatever. Right. But I'm just saying, if you have to look at it from that perspective, how do you reevaluate this risk-reward? For example, even though I'm proud that Grab is a Singapore-based company, they're making their name renowned worldwide, being listed. You have companies like Razer as well. But on a fundamental level, if you look at the businesses, you analyze it objectively with a cool mind, think about it. What's your end goal and where do you want to achieve with these different developments? So this is really, I love digging into these different businesses and think about companies like C Limited, companies like Lazada, companies like Alibaba, Tencent, how they're making money, and all your different other more popular companies out there. And there is also a reason why when you put your money in a certain company, rather than saying this company is yielding a certain CAGR for yourself, maybe a 20% CAGR, 30% CAGR, that's incredible, by the way. Warren Buffett only had like a 20% CAGR, of course, of a very long track record. But rather than saying that you want to purely earn money from the stock market, I think there's a very important aspect of supporting the cause that you actually believe in. So for example, you believe that Google is going to be the next big thing. You want to support maybe Amazon going to be the next big thing. You want to put money and have skin in the game. That's also a way for you to vote in essence. Put your money behind, or put your dollar behind the founder, put your dollar behind the company, and hope that we make the world a better place, and express your world opinion in that sense. So investing to me really is that's how I qualify it. Apart from, of course, trying to fight inflation and just earn money on a very rudimentary level. So that's how I view it.
Cool. Yeah, that's kind of like how I stay interested in investing as well. It's like beyond making money, it's being able to observe the execution in interesting strategies. You know, it can be anywhere in the world. That's what's fun about it. Just pick a company, you can just trace back their strategy for the past 5 years and see how it plays out, and then they'll give you some sense of where do you think the next 5 years is going to be, and you can sort of see how all the different players are fighting perhaps for the same market, and then test out your theories in a somewhat safe environment, because you don't have to put so much money in. Like if you wanted to, you can nibble at it and see and learn about yourself also, like how much risk you can stomach, like you said earlier. What type of investor are you? Because it's like a discovery phase. Actually, no one can exactly pinpoint. I'm 60% risk and 40% conservative. Like so it's an ongoing discovery, right? Cool.
I think at least on that point, right, about testing your own theory or testing your own strategy, right? I think one very important pitfall, or at least maybe I am constantly reminding myself as well, is there is always this ego thing at play, right? You want to know you're always right, because humans like to know that we are right. We like to know that our bets are right, how we look at things are right, how we read different narratives are right. But there comes a point where we will definitely be wrong somehow or another. And we need to have that wisdom to know that, hey, we're wrong. Let's move on. I think that's something I'm grappling with as well, because people have been. YouTube is a very open platform. I tend not to, or at least I never censor comments. So I don't delete comments. I take everything, and I sometimes read and I don't reply, because sometimes it might affect some of my feelings on how I felt that day. But that said, of course, people have been constantly bashing on a lot of all this Chinese tech, and there will definitely be a breaking point or tipping point to say that, hey, let's admit defeat that, or maybe rather than saying that it's an ego problem, or as long as I don't sell out, I don't lose money. I think that's also a very toxic kind of mentality to have when you go into the market.
So many caveats to that statement, right, that you leave out.
Right. So that's the issue, right? Because in investing, there are many school of thoughts. And I think out of the many school of thoughts, there are definitely pros and cons to every single school of thought. You can be a trader, you can look at technical analysis, you can only care about fundamental analysis, you can look at growth investing, you can look into value investing. Nobody's stopping you. It's a free market. You can deploy your capital however you want to. But there are also a lot of oxymoronic statements in investing as well. So one will counter another. So in this case, you just have to be cognizant enough to really sort out your thoughts, and before going into or entering any position, you need to know what you're getting into. And this is also something that I love about investing. There is technically no 100% correct answer. There are only different perspectives. So, like I said, the Amazon, in hindsight, it looks like a stupid bet when you are holding from $100 to $3. But after all, we are back at few $1,000s highs. Same thing likewise in the dot-com bubble. Texas Instrument was at a highs of around 280 to 300, if I'm not wrong, off the top of my head. Today, it hasn't even traded back to its highs of the dot-com bubble. So how do you know that whatever you're picking today, is it the Amazon of the future or the Texas Instrument of the future? And then you are so stubborn to not release and to not find better opportunities out there, and you held all the way through. And worse still, if it's pets.com, it's missing, and that's even worse. So in that sense, you have to be constantly looking through a lot of your different investment theses. You have to be looking through a lot of the annual reports, how the competitors are doing, and stock picking is an extremely tiring game. It's an exhaustive game, especially when you're constantly in tune with the finance news. Today, Ukraine did something again. Oh, tomorrow interest rate is rising. This day, Jerome Powell said something again. It's extremely taxing. So if you do have something more fulfilling out there, like if you have kids to be with, You have a wife to take care, you have your parents to take care, you have a fulfilling life you have an enriching career out there. I would not venture people into stock picking, like I said. So it's good to just increase exposure, always remain exposed to the market, but stock picking, even though me being a kind of like a finance YouTuber or someone that talks about stock analysis, etc., by it's a disincentive for me to tell you to not go into stock pick because you will then not watch my videos. But that said, I think it's the responsible thing to do to tell people that, hey, this is kind of like a disclaimer or warning before you step into this entire black box of a stock market.
Right.
So definitely it's a lot fulfilling as well if you are able to generate consistent alpha and generate consistent returns. But that's it. I'm not going to discount and not going to tell you that it's a bed of roses and it's just rainbows and donuts.
It's not for everyone, basically. Yeah, but if you are the kind of person that can stock pick, the YouTube community is out there for you to explore and enjoy.
Right.
Yeah. So I found it quite funny because when I started investing, my picture of it was you make good choices a few times and investing becomes this passive thing that sets you up for the rest of your life. And like how wrong I was is what I found out very quickly.
I think it can be though.
It can be if you have capital.
Right. It can be if you swing. I think there is this discussion from Warren Buffett. It said like let's say you only can he gave out this thought experiment, right?
I remember that one.
Only invest like 10 times or 20 times in your entire life, you'll be extremely careful with your decision. Because every single one that you put in your money, you have one less decision in your entire life. And that also made people think a lot more before they pump in money or before they start pressing the buy button. But that also means that you have to be a lot more stringent, a lot more conservative, a lot more stingy with your calculations.
You have to wait a long time before that opportunity falls within your requirements, basically.
Right. And surprise, surprise, Munger didn't buy anything for the last 5 or 8 years, if I'm not wrong. And his next purchase was Alibaba. So it's the kind of temperament that you're equipped with naturally. And of course, and the later part of your years, you will also have the opportunity to hone your skill set. But along the ways, you're gonna screw up here, and another. You're gonna take a lesson, or you're gonna take a beating from the market on one form or another as well. So that's really up to you to decide how you're gonna internalize the lessons and to come back stronger as an investor as well.
Cool. All right, Chi Keng, thank you so much for your time. Where can new viewers from either of our channels find you on the interwebs?
I think you can definitely just type in my name in YouTube. I believe that I have a unique enough name for people to Google me. I do post some Twitter content from time to time, but that's about it. I'm hardly active on Instagram, TikTok, etc. So I primarily operate on Twitter and YouTube. So yeah.
Thank you so much for your time.
Yeah, sure. Thank you.
Thank you. We hope you enjoyed our interview with Chi Keng. One of the things I took away from this interview is that when he answered about the qualitative features of management, he didn't have to think about it for very long. He knew the execution of their management like the back of his hand. And that's what it takes to be a long-term investor in a company. You have to be basically a business owner or strategic partner. The other thing that I appreciated from this interview is that he takes on a macro view of the world economy, not just specifically in China or just in the US, but internationally. And that's very helpful, I think, as long-term investors because we need to have an open mind and see opportunities wherever we can. If you're interested to hear more from us, subscribe to our channel to get notified every time we release new videos about personal finance, investing, and more. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you find this helpful, share this with your friends and family. We will see you in the next video. Our guest tonight is an expert on Chinese companies, a long-time bull, Alibaba bull, and sorry, need to retake.
No worries.
Sorry.